Welcome to this class of macroeconomics. The topic is on money in banking. From earlier videos, you've learned about supply of money, where in any economy, the banking system consists of two financial institutions, where you have one central bank and a number of commercial banks. The role of the central bank is to control the credit, whereas the commercial banks have the main functions of creating the credit by advancing loans from the deposits of the public. So here we'll try to learn in detail about how the process of credit creation in an economy is done by commercial banks. And at the end of the discussion, you'll also come to know about the meaning of multiplier. So we'll base our discussion from the text. We'll follow the yellow highlighted paragraphs. We'll learn about this money creation of banking system or credit creation by commercial banks. So what we have learned, commercial banks have two main functions. Primary functions, they accept deposits from the public. We go and save at the bank, and out of that saving deposits, it lends out part of these funds to those who want to borrow. That is, the second function is to grant loans. So bank can lend simply because they do not expect all the depositors to withdraw what they have deposited at the same time. When we all go deposit with a bank, not all of us will go at the same time taking out our money. So fully aware of that situation, that's why it can keep some and lend the rest. So when the bank lends to any person, a new deposit is opened in that person's name. That is the point that you have to take note. That means you go and take loan from the bank, you will not get the money in cash. Instead, if you don't have account, they'll open an account for you and the money is transferred. There is no exchange of money per se, but there is only a transfer in the accounts. In that way, money supply increase to all deposits plus new deposit. From the old deposit, it can lend out to those who take the loan and open that account for them. So from the primary deposit, it can give loan, and then subsequent deposits can be open. Okay, so let's take an example. Assume that there is only one bank in the country, and let's say that we have also learned about the balance sheet earlier video. Let's say that this bank has a deposit from the public equal to 100 rupees, and that deposit is a liability of land because it owes to the person who deposit this amount. It's not the asset, it's the liability. It has to return whenever they demand. Okay, this could be because Miss X has deposited 100 in the bank, so it owes this person 100 rupees, so it becomes a liability. But we all know that there is a time gap that the person can withdraw the money, so that's why it will keep this amount as a reserve. Let this bank deposit the same amount with Reserve Bank as reserve. So when it accepts the deposit from Miss X, if you look at the table, this is deposit, and it has to keep as a reserve with the Reserve Bank. And we have also learned about the CRR, not it? And so if there is no CRR at this moment, suppose it it will 100% keep it as a reserve. That reserve becomes an asset. Remember, asset is reserve plus money supply is equal to 100. And we have also learned during that videos on the RBI prescription on money supply. M1 is currency plus deposit. Here there is no currency. We assume that all the money is deposited in this bank. So that's why the money supply without currency is equal to this deposit, which is 100 rupees. So from here, what we can learn is that you know the balance sheet, you can find out how much is the money supply in the economy at that point of time. This is a simple example of one economy, one person. Okay, but we all know, we have learned from the earlier class that commercial banks has to follow guidelines from the Reserve Bank of India or central bank, and the central bank has in its disposal the instruments where it can control credit. Otherwise, if it doesn't control this deposit by this person, can be created um, loans, which is over and above its capacity. So that's why there is a CRR. Remember, we have learned last class. I will not take this now. Suppose there is a CRR, and that CRR, let's go to this yellow highlighted paragraphs. Let's assume that our bank starts with a deposit of 100 deposited by Miss X, and assume that the CRR is 20%. The Reserve Bank stated that as rule they have to save, they have to keep as a reserve before they lend out 20% of the deposit. So that's why we come to the point where if 20% is the CRR, and out of 100, that 20% is um, out of the 100 minus this 20%, what's left is 80 rupees. 80 rupees. So this 80 rupees is the excess amount that the bank can lend, and so it lends this to another person. Okay, receive 100 as deposit, keep 20 as reserve. The surplus is 80. This 80 is then lent again. So when it lends you, so this will show up as a bank deposit in the next round of liabilities. And we have learned that also, that when it lends to people, when it gives loans, it will open an account. It will open an account to the person who takes loan. So a loan becomes a deposit. Okay, if you look at the table, you will see that in the first round, Miss X saved 100, bank keeps 20 reserve, 80 is then lent. This 80 is a loan, but becomes a new deposit, a second deposit from the primary 100. Now the bank opens to Mr. Y 80 as a deposit. So the total deposit in the bank now becomes 100 plus 80, 180. Okay, out of the 100 rupees that is being deposited, now it becomes 180. You see how money keeps on multiplying, how money is supplied, how credit is created. Credit creation gives rise to increase in money supply. So we also learn that now that the bank has 180 as deposit, not 100, now 180 in second round. So 180, it can again keep 20% of it as a reserve, and if you calculate at 20%, it becomes 36, and the rest is loaned out, 64 rupees. That is the second round. So what do you see from here? 100 rupees deposit, give loan 80. Deposit becomes 100 plus 80, 180. Out of that 180, reserve 36, give loan again 64. Okay, and this process goes on and on. This process keeps repeating itself till all the required reserve becomes rupees 100. And if you want to, even though in your book it doesn't show in detail, how the process goes on, you can check out from the calculation that can give you an idea how many times this deposit can multiply to create more money. So you see from the book, it's shown 100 rupees deposit, 20 reserve, 20 loan is made. And when 20 loan is made to another person, they open an account, it becomes 180 rupees. 180 keep reserve as 20%, 36 rupees, the rest is loan out. When it is loan out, it becomes a deposit. So 180 plus 64, 244 is the new deposit. 20% reserve of that is 48 rupees. The rest is loan out. When it's loan, they open an account, new deposit is open for that third person, and so the total deposit from 100 becomes 296, and this goes on and on. How many rounds? If you see, up to 41 rounds, say 41 number of borrower, or it may be for the same person, but what we can sense from here is that out of the 100 rupees of deposit, if they keep 20% as reserve till it reaches that original deposit, they can create a loan up to 400. So that's why you understand, even with small amount of deposit, the bank can create more deposit. By creating more deposits, it creates more money out of nothing. Why? How can it do this? It can do this because, like we have learned, the bank knows fully well that not all people will come and withdraw the amount of money. That's why it can lend out. Okay, so from 100 rupees original primary deposit with the CRR, it can create 400 loans. So that's why the total amount deposits created is 500. Okay, so what you can get now is to look at the new balance sheet. The new balance sheets become deposits original 100, reserve 100, and it gives loan to 400. The total loan amount after many rounds, it becomes 400, and by giving loan 400, it creates a deposit of 400. So that's why deposit original and subsequent deposit becomes 500. 500 it has to pay because it's deposit, it's liabilities, but at the same time it creates asset for the system. So if you look at this, reserve plus loan plus cash becomes 500, and the liabilities that it owes is 500. This is the idea of credit creation by commercial bank. And so you also have a sense that if this is not checked, then there will be over creation of credit. So that's why we have the central bank in India, we have the Reserve Bank of India that controls this through its instrument. Okay, so let's try to conclude this. Since the bank, we'll see from here, since the bank is only expected to keep 20% of its deposits as reserves, thus reserves of 100, which is the original of the deposits, which is 20% of 500, can support the deposit of 500. From 100 of deposits, if it keeps on creating the loans and deposit, that will amount to 500. In other words, our bank can give loan of 400. 100 primary deposit, loan 400, meaning subsequent deposits 400. So the total deposit become 500. That is clearly explained and given in that table. Okay. So now that we have learned about that process of credit creation earlier from 100 rupees, we can now find out what is the total money supply in economy if all the money is deposited or with the bank and there's no currency at hand or in circulation. We can see that money supply M1, which is the narrow definition of money supply, is currency plus deposit. No currency, every currency is with the bank as deposit, so that's why the deposit is 500. The money supply has increased from earlier 100 to now 500. Money supply increased from 100 to 500. So what we learn from here is that given CRR 20%, the bank cannot give loan beyond 400. So that's why we understand that is the restriction being set by the Reserve Bank, so as not to over overgiven of loan, so that to keep check on money supply. Hence, requirement of reserve as a limit to money creation. That is the power of the central bank. So that's how you can understand the multiplication of money in the economy. It's done by these commercial banks. Then so many of them, not it? So that's why, um, based on that calculation explanation, we can come to the next concept of multiplier. That means if you know the cash reserve ratio, how much that each bank has to keep with itself before given loan from the deposit, we'll be able to learn about the multiplier. What is a multiplier? Multiplier explains the total advances in terms of loans that a commercial bank can make from primary deposits. How much from the primary deposits of 100 can banks advancing loans? That is the concept of money multiplier. Money multiplier helps us to understand that if you know the CRR, up to what extent can a bank gives loan? Okay, so the multiplier is the inverse of the CRR. If you know the CRR is the inverse of it. So in our example, multiplier, money multiplier is equal to 1 by CRR. CRR is 20%, so that's why the multiplier is 5. Thus, what you mean by 5? It means that if you have deposits of 100, which is the reserve of 100, it can create deposits 5 into 100, 500. Okay, from the primary deposit up to what extent, from the primary deposit of 100 up to what extent it can create loan, up to what extent it can supply money, multiply money, we can find with the help of multiplier. Okay, so 5 is the multiplier. It means that the money that can be multiplied by this banking institution is 500, 5 times. Okay, this is a very important topic, because we come to learn about the day-to-day activity of the commercial bank, and at the same time it creates credit, it supply money to the economy. Of course, the money has to be issued by the Reserve Bank, by the central bank, but these commercial banks are the ones that are on the ground creating the money, creating the credit. So what you've learned? You've learned about the process of credit creation by commercial banks, and also you can define the concept of money multiplier. If it is 5, it means 5 times from the deposit bank can multiply, can create, can supply money. Okay.